Hi, good morning. It's Dan Moorhead. Thank you all for joining the Liquid Token Fund investor call. There's a ton going on in all markets, global macro markets, our market. And so I want to just hop straight into this fund itself. And then at the end, give a few thoughts about the global markets themselves and blockchain kind of big picture. And then some firm updates. With that, I wanted to just do a quick overview of the fund itself. We have 14 positions in the fund. The fund has about 8% in our quant strategy. It's a strategy we've been working on actually for about 6 years now. And with that, I want to just hand it over to Joey to jump right into the portfolio itself.
Thanks, Dan. So jumping into the portfolio side, if you look at kind of Q3 performance and compare it against Bloomberg, overall Q3 we're down about 0.5%, and Bloomberg's up about 16.1%. And if you kind of look into the breakdown and attribution of why that is, and I'll kind of go over this towards the end of the performance section, but basically in Q3 we owned a good amount of Bitcoin at the start of the quarter, and then mid-July, once the Ethereum merge was announced, when it had kind of a final date, we basically rotated a lot of that BTC into ETH. And so that led to kind of some underperformance in July because ETH moved up a good amount in the first half of the month. And so we kind of missed that wave of performance, which basically set us off for the rest of Q3. But then if you look at month to date, the fund's down about 1%. Bloomberg's down about 3%. And then if you look kind of year to date overall, Liquid Token Fund's down about 75%, and Bloomberg's down 66%. And if you go into kind of the breakdown behind the reasoning for why that is, there's basically three things that I'd say that we got wrong this year. One is that we didn't anticipate how much interest rate hikes would affect crypto. Two is that if you look at our Luna position, which we talked about in the last quarterly performance update, we had too high a percentage of that going into the bear market. We did de-risk some in April, and once the peg started to break, continued to de-risk as much as the rest of the position as possible. But it still led to about a negative 14% performance hit in Q2, and that's actually the bulk of the delta between us and Bloomberg. Essentially, if we didn't have the Luna issue, we'd be slightly beating Bloomberg, which would be sort of in line with what we expect in bear markets for our strategy, which is to kind of perform in line with Bloomberg and then to outperform in bull markets. And so I think kind of the learning lesson from that is basically don't, for these kind of high beta assets, we shouldn't really hold too large a position into a bear market. And then I think also on Luna, it was kind of this, trade where basically we were trying to basically maximize the EV of it. And we probably went a little too aggressive in terms of just maximizing pure EV without as much optimizing kind of for the risk adjusted performance of it. And so that's, I think, a kind of a learning lesson there. And then the last one is the one I already mentioned, which is one that kind of directly impacts Q3 performance, which is a little slow on just rotating back into ETH in July. Although we currently have a very large ETH position and are very bullish on ETH itself. On that note, there are a couple of things I think we got right this cycle. One of them is that we cut all our low conviction altcoins this spring, rotated basically very heavily into layer ones like ETH and Bitcoin. And then the other is that in 2021, we sold most of our DeFi positions. We still have a couple things that we're bullish on long term, but for the most part, the fund is very low exposure to DeFi, especially versus what it has had historically. And if you look at DeFi performance since then, DeFi is down about 70% versus the ETH peak. So if ETH's down 60 something percent year to date, DeFi is down even more. And so, if we'd held on to those DeFi positions, I think the fund would be in a much worse spot. And that's something that we did learn from last cycle where we bought DeFi back too quickly. This time we've basically been really waiting and being patient to make that trade. And then when we do, hopefully we can kind of make the performance back up on the upside. But really wanting to be very close to almost certain that DeFi's bottom versus ETH before we ratchet up our DeFi exposure, essentially because DeFi is down so much since the peak. If you start looking kind of month by month performance contributors on this slide, basically, this is kind of broken down between top 3 contributors and top 3 detractors from performance. In July, most of the performance was Bitcoin. Uniswap rebounded quite a bit from the June lows, and then ETH. We didn't get full exposure to that ETH upside because we only bought the position back mid-month. And then, kind of on the least performing assets, you have Polkadot, Phantom, and Cardano. Phantom and Cardano are something that we trade in the quant strategy. It's not something that we, at least historically, have fundamentally bought from like a discretionary standpoint. And then if you look at August, August was a down month, and so is September. And so if you look at those 2 months, the positive contributors are basically the things that were down the least. Things like Near and Lido. Lido did pretty well versus the market because people were kind of bullish on it entering into the ETH merge. And then on the negative standpoint, Uniswap and Maker kind of gave up a good amount of the July performance. And then in September, it's kind of the same story. Nothing really stands out too much outside of Luna 2.0. That's a position that they basically airdropped to all the kind of Luna V1 token holders. And so we have a Luna 2.0 position. It's something that it's not liquid. We can't sell it. And it kind of essentially vests over a period of years. And so, we'll eventually be able to get liquidity on that, but it's not, it's not like we have a large Luna 2.0 position. It's more just that we got that airdrop after they basically did a fork to launch the second version. And it's something that we're, basically kind of stuck with for now. We can't trade it around. And so looking at the portfolio as it stands today and kind of what our current positioning is. So, we're still kind of taking the same bet of being overweight large caps and overweight kind of smaller things and really underweight the middle. So I think there's a lot of stuff that's still, relatively overvalued in the middle, kind of, top 4 to 12 assets or so. There's not a ton of high quality assets there. And then on the large cap side, very kind of overweight ETH. We were overweighted into the merge. We're still overweight. Post merge, kind of ETH draw down a bit versus Bitcoin. Now it's kind of bounced back on a relative basis. And, in our view, it's still kind of in a bullish trend versus BTC. And I think it's going to be in a bullish trend versus dollars. If you look at kind of the ETH chart, it's basically tested a couple times the support line since the June low. And I think it's going to basically continue to hold that support. And so we're very bullish on ETH on a relative basis. The reason behind that, it's not like we're going to hold a ETH like beta fund. It's basically just that we think, in the first number of months of a new bull market, layer ones will really outperform other assets. And the intention here is basically to rotate out of that ETH when it's clear that things like kind of the smaller DeFi assets have bottomed, or other kind of, more interesting kind of novel, layer 2 or layer 1 architectures. But right now, as we're kind of basically coming out of this bear market, if you assume that the June, $890 ETH low was indeed the low, coming out of that, we're basically very bullish on ETH relative to everything else, because I don't think a lot of that higher octane stuff is going to bottom versus ETH until it's very clear in the market's eye that ETH has bottomed. That's something that, we intend to rotate out of. Probably, I would say early next year. A lot of it kind of depends on global macro and kind of people's views on risk assets as a whole. But we have a list of assets that, we're kind of constantly monitoring to decide when to eventually buy and rotate out of that ETH into other stuff. We just don't want to do it too soon, because if you've been an LP since the very beginning, you remember the last cycle, we rotated pretty heavily into DeFi, I would say too soon in like 2018, 2019. And that led to a lot of negative performance versus ETH, because basically it continued to draw down. And so just really want to be cautious that we don't make that same mistake again. And so if you look at different types of assets, this is kind of a similar story. It basically goes over a lot of the same stuff in the last slide. The only difference is you can kind of see some more use case breakdowns here. So we have about 4 to 5% of the funds in layer 2s. So these are kind of the scalability solutions that exist on top of Ethereum, things like Polygon, things like Optimism. that sort of thing. And yeah, I think during the next kind of bull cycle, these are going to be a thing that there's a really strong narrative around. The one that we're actually kind of the most bullish on, I think Arbitrum, which has the most traction, doesn't have a token life yet. That's something that we would look at once it actually is, because I think that if you look at kind of layer ones and layer twos, all these new kind of scalable layer one chains are now trying to build bridges to Ethereum to like be able to transmit assets and data back and forth in a secure way. The layer twos have already solved the bridging problem, but they're just not quite as scalable as the other kind of novel layer ones like Solana, Near, that sort of thing. And I think that's going to be the problem that they end up solving, over the next 6 to 12 months. And so I think it's going to be a huge narrative in the next bull cycle. The rest is more kind of traditional DeFi positions, a little bit in lending and dexes, that if you add up to roughly 20% or so of the portfolio. And there's a few things that don't quite fit into any category. And so if you look at kind of the portfolio by the different category kind of breakdowns, you have layer ones, you have layer twos, a couple of miscellaneous DeFi things that aren't quite the same as regular DeFi, things like Lido, which is a staking, a protocol that basically lets you stake your ETH and then get a derivative that's pegged 1-to-1 to the ETH. So you basically get a liquid derivative in return for staking your ETH. And then the protocol charges fees on that. So that's kind of how it makes money. That's a position that we're quite bullish on. On the decentralized exchange side, things like Curve, Uniswap. On the lending side, things like Maker, which has gotten beat up a lot versus ETH and kind of is in a very negative standpoint from like a narrative standpoint, but still has some of the highest traction, actual usage, actual kind of revenue and stuff for token holders of any DeFi protocol out there. So that's something that we have a position on that we're just bullish on because we think it's oversold. And there's a couple of things that, again, don't quite fit into any category. Things like Arweave, which is decentralized storage, that sort of thing. And so if you look at from a infrastructure standpoint, on the layer one side, already talked about Ethereum, already talked about Optimism and Polygon. The only things we didn't really talk about too much are Solana and Binance Chain. And so Solana is something that I think if you look at it year to date, it's really gotten kind of beat up versus ETH. I forget the exact percentage, but it's down something on the order of 50% versus ETH. And our view is that that's close to bottoming out if it hasn't already. And the thinking there is that you have a bunch of kind of Solana competitors launching, things like Aptos, things like Sui, and our kind of in-house view on that is that those are going to be relatively disappointing. They're not going to launch out of the gate with a ton of applications. And I think like the other kind of issue here is that if you look at what Solana's built, building this stuff is not trivial. The biggest criticism of Solana is that it has like these kind of network outages where the network kind of grinds to a halt. And if you think about Solana as a investable asset, basically if they fix that problem, if they fix the kind of network outage issues, and these other kind of main competitors launch and are kind of essentially duds, then I think you could have a very positive environment for kind of Solana, positive price action over the next 6 to 9 months if those two things play out. So we have a Solana position on, obviously not anywhere in size to our ETH position, but it's kind of one of the first things that I think as we start to kind of enter the next cycle here, we think will outperform other kind of assets like ETH and Bitcoin if they fix the scalability issues, which is something we're monitoring very closely. And with that, I'm going to hand it over to Dan to talk about some more market thoughts.
Great, thanks, Joe. Yeah, so this first graph is just to highlight how these different sectors that Joey was talking about have performed, and why we're really bullish on some of them. They really did get down to very inexpensive levels relative to the traditional sectors they're disrupting. And on the next slide, it's something we've been forecasting, which is now starting to happen. The surprising high correlation between crypto and interest rate sensitive assets like stocks and bonds lasted much longer than we forecast, but it's encouraging that since the middle of the year, that correlation seems to be breaking down. Risk assets like stocks are down a bit since June 30th. Gold's down a ton. Obviously, bonds are down a huge amount, but digital gold, crypto, is starting to do its own thing, and that's our bet for the next 18 months or so, is that we think that even if there's a lot more stress in the in the global macro markets, crypto can do well. And then on the next slide, just graphically reminding everyone that although Bitcoin is the kind of the number everyone always thinks about as a price for our industry, it's not really a great indication of what all is happening in our industry. There's a lot of interesting tokens that are out there that are beyond Bitcoin. So I wanted to wrap up with a few updates on the firm, and then Franklin's going to talk about the first summit we've done outside the United States, and then I'll come back to talk a little bit more about the non-crypto markets because they are important to us all. We have tried to scale our firm over the last 18 months. We've been mainly successful. We've increased the firm's headcount by more than double. We're at 70 people now. We are in the middle of a process to essentially add a C-suite layer into our existing firm. We have 70 fantastic people, but we want to be able to scale the firm, and to do that, we need to add a whole new layer of C-suite people to help us scale. And we have hired a fantastic president, Jasper Lewitton, who comes from 12 years of working for Ray Dalio at Bridgewater. He's been with us 4 or 5 months. And then we did have a few missteps where we hired a couple of people from massive institutions or the US government. And unfortunately, it wasn't a great culture fit. And we are in the midst of refilling those roles. And so over the next couple of months, we should have a few new C-suite people to be introducing to you. And with that, puts us in a fantastic position for growth and scaling. The important point to note is that kind of the engine of our firm, the investment team, is rock solid, same people, have been here for a long, long time. And then we're adding a handful of junior people to the investment team. With that, I want to hand it over to Franklin to share a bit about the summit we did in Singapore.
Thanks, Dan. So earlier this month, we held our first blockchain summit in Asia. It had about 250 people attending and was an awesome week to do it. We did it as part of Asia Blockchain Week, and the same week as Token 2049, the Milken Conference, Formula One. So it was really a great opportunity to get together with our LPs in the region, as well as our founders and portfolio teams from over 60 companies around the world. Singapore was a great choice to kick off the first Asia Summit. It's actually home to 13 of our portfolio companies. So we have a great community to draw from there. And that really reflected in the agenda we were able to put together. We covered everything from institutional investing into blockchain, bringing folks from Temasek and other institutional investors onto the panel to chat about the challenges, the opportunities. We had folks from Amazon and QuantStamp and Flexa talk about enterprise adoption in Web3. And then we covered all the big themes within our early stage portfolio, things like the metaverse, NFTs, and then DeFi as a broad topic for us and our portfolio founders. The summit was recorded, and we actually included links to the recordings in the blockchain letter that just went out, but you'll also be able to find them on our website by tomorrow as well. So feel free to take a look. There's a lot of great content in there, and we hope to do the same again in our annual blockchain summit in San Francisco early next year in April. And with that, I'll pass it back to Dan to cover some of the macro thoughts.
Franklin, thanks. That's the end of the crypto portion of this. So for those of you who are only interested in crypto, can hop. We are answering questions in the Q&A box. If you have questions, feel free to put them in there. And then in a couple minutes when we wrap up here, we'll take questions live. Just want to give you an update on my strong view that rates had to rise a ton. And they're actually pretty much on the pace we predicted in December. I do think rates still have to keep going up. There's this kind of mentality out there that the Fed will stop when they've caused a recession. And unfortunately, that's not the Fed's mandate. The Fed's mandate is to have stable prices, which they've defined as only debasing the currency 2% per year, and full employment. And unfortunately, the unemployment rate's still record lows, wage inflation, record highs. And in most parts of the country, housing's still up 8.6, I think, median home prices nationally. So until the housing market really does come off and the unemployment rate rises and wage inflation starts going down, the Fed has to keep tightening. And a little known fact is that the owner's equivalent rent part of CPI is a very slow moving animal. And the Federal Reserve of San Francisco did a cool study that shows that even if housing were to flatline immediately, which is not yet happening, that it would add 1.1% to the inflation rate for the next 2 years. And so the Fed would need to get everything else to be 0.9% in order to hit their target. With core CPI at 6.6, that just is a really, really, really big gap. And then the bottom graph is an update of one of my favorite graphics we've ever done, is the overvaluation of the US Treasury and mortgage bond market. In December last year, it was 15 trillion overvalued. About 60% of the air has come out of that bubble, but unfortunately, it does seem like it has a ways to go. And on the next slide, we have a cool analog that my colleague Jeff Lewis wrote and that we sent out today in our investor letter about blockchain being kind of like the .com thing in 2003. For those of you who were investing back then, we'd had a bubble of hype with this new technology, a bunch of protocols that moved information around. And it took a couple of years to kind of wash all that out. But that's when some of the best companies were formed. And on the next slide, we have just a graphic. Oh, I think maybe we don't have that one. Yeah, sorry, we don't have the graphic. In the investor letter, we do have the graphic of, so many of the coolest and most valuable companies were formed, after the bubble. And so that's our view on blockchain. It's kind of like in 2018 and 19 when we invested Venture Fund 3. After the bubble is a great time to invest. So it's probably going to be similar in our space. And with that, I want to open it up for questions. Joey's taken some electronically, and then he might want to take a few right now.
Yeah, the only one that I didn't answer in the chat box is there's two more now, but one is from Mark Jones that asks, does our zero Bitcoin holding reflect the view that Bitcoin's peaked and broader adoption will come from other chains? Given things like Lightning Network, does it make sense to have zero allocation? How do we think about that? I don't think that the view basically isn't that like Bitcoin has peaked. I think Bitcoin's going to likely continue to go up in the future for years to come. It is a view though that a lot of the kind of like next wave of adoption is going to come from other chains. Like if you look at Bitcoin in our minds, we very much view it as basically this digital gold style asset. I don't really foresee smart contract adoption or things like that actually happening to any meaningful degree on top of Bitcoin. It's one of those things where it's sort of like cold fusion, like people have been trying it for forever, and it's just not really doable. And so then I think that kind of forces you to look at other assets, things like Ethereum, things built on top of Ethereum, And I think that's where a lot of the adoption is going to come from. And then I think there's also this interesting dynamic, which is if you look at Ethereum, and Dan sent out an investor letter about this a couple months ago, with the new kind of monetary policy post merge, ETH is actually less inflationary than Bitcoin. Last I looked at it, it was about 0.05% inflation a year. As adoption kind of starts to pick back up as markets continue to recover, I think that ends up going negative. So ETH becomes a deflationary asset. And so you have kind of two really interesting things. One is you have this kind of monetary unit that's basically deflationary over time, which is Ether. And then two is you have this basically kind of tech smart contract platform, which you value more like a tech company essentially. And but it's pretty rare that you have tech companies where their stock is deflationary, where they're just continuously buying back shares, especially at kind of the phase of life that ETH is at. You see that some from later stage companies like Apple, but Apple is many decades old. ETH is fairly young, and so I think it's just kind of an interesting, unique asset to own. But to my point earlier, it's something we'll rotate out of as we kind of get more confidence that we're entering into kind of a new bullish regime over the next couple of years. It's not like we want to hold 50% ETH for 3 years here, but more it's just for a number of months until it makes more sense to rotate into other higher octane positions. I'm going to hand it back to Dan. I think there's one or two questions on his end.
Yeah. Hey, to follow on to Joey's answer on, has Bitcoin peaked? The analog I did at the SALT conference last year was Microsoft analog, and I really love it. In the late 90s, Microsoft was a massive $200 billion company. It controlled almost all software. And over the next 25 years, Microsoft went up 10x, which is amazing. We'd all love to have 10x assets in our portfolio. But 80% of the tech gains over that period of time came from new things like Apple, Amazon, Microsoft, or Facebook. And that's the way I view Bitcoin. Bitcoin's amazing. It's done incredibly well for 13 years, but it's already pretty big. And so it can still go up, 10 or 20x, but it'd be difficult to go up 100x, whereas a lot of the things in our portfolio could. And so I think that although Bitcoin's going to go up a lot, the majority of gains are going to come from other things. Maxine asked the question about, the NASDAQ. Here's a cool stat. Bitcoin vol now is below NASDAQ vol. So that's the first time in a long time, probably ever actually. And so that is a great sign that things are, A, calming down, which is important, but then B, that slide we did of the performance of the crypto industry since June 30th, crypto up, everything else down. So we are starting to see the beginning of a decoupling. And, that is a large part of what we're forecasting here is that, crypto can do very well, even if other assets are still struggling. And with that, I think we have answered all the questions. I want to thank you so much for participating in the call. If you do have questions that come to you later, we'd love to be transparent and be helpful. So shoot them to ir@pantheracapital.com and we'll get the right person back to you. Thanks a lot.